What's better than earning money from a 9-to-5 job? It's earning money while you sleep, which is made possible if you start investing. You're listening to the Real Estate Investing Demystified with your very own dynamic duo, Ava Benisaki and August Biniaz. Tune in as we discuss everything real estate, both on the passive and active sides. We feature life-changing stories of today's real estate leaders that will help build your own roadmap to success. This is a show that will lead you to a diversified portfolio, a much bigger revenue, and a next-level venture that brings you a smooth cash flow. Let's get this episode started. Welcome back, everybody. We're excited to be here today. We have a very special guest.
I know we always say special guests.
But this is like a really, really special guest.
Our guests are very special, but our guest today is particularly special, and we're going to get into it because I've been kind of on this journey of finding this person in our lives.
A journey to say the least.
It sounds romantic, but I've been kind of like in the process of finding this person for a long time. I think it's been a good 2.5 years, 3 years, and connecting with many others for this for this role within our company. So we've been looking for an acquisition director, asset manager for CPI Capital, and it's been an interesting journey to say the least.
It's been a tough journey. It's not easy finding a good partner out there.
Exactly.
Who you're going to trust your whole baby with, right?
Exactly.
Yeah, and we found our guy.
In this situation, as a partnership, this is not an employee or a contractor. So we're very excited. And that was a big decision we had to make because we really dedicated our lives over the last 3 years. And even prior to that, the idea for CPI Capital started well before.
That's right.
3 years ago. But we spent our last 3 years of our lives, both of us leaving our careers to build CPI. And for us to then bring on a partner and,
that missing puzzle piece.
Yes.
When the puzzle gets completed, how good it feels?
Yes.
That's kind of what we feel right now.
And your family was in town last week, and you guys were actually doing some puzzles on the dining room table there.
Yeah, we finished it off. It was a difficult one. But work aside, once we get into, everybody will learn about Paul Hopkins today. On a personal level, he is such an amazing person.
He is.
We have a lot of interests that we share, like learning about longevity and how fasting can benefit us. And he's an amazing father. He's an amazing husband. So it's really about the inner person as well.
Yes,
and then, of course, work side, he's just amazing.
Frankly, we're just so lucky to have met him and to be partnered with him. So we're just excited. As you guys can tell, I'm sure if our regular listeners and viewers know how excited we are because they know that this is an exciting time. So let's get into it. Let's talk about who Paul Hopkins is.
Now that we got Paul blushing, maybe we should get
well, I'm blushing now, Ava. So yeah,
that's right. Okay, well, let's dive into who Paul is. And here we go. Here's a little bit about his bio. Paul Hopkins is an experienced real estate professional with 17 plus years of experience in the construction industry and 7 plus years in multifamily asset acquisition, repositioning, and development. He most recently consulted for a private equity real estate investment company performing all aspects of acquisition, underwriting, financial analysis, due diligence, and asset management. So prior to his consulting work, Paul was an operations manager on a $2 billion infrastructure project in Canada. So in this role, he managed engineers and contractors with respect to contractual relationships, vendor selection, budget estimating, forecasting, and project scheduling. So additionally, he was responsible for user coordination and overall project delivery. So within his past roles, Paul has gained extensive knowledge in areas such as design build projects and public-private partnerships. As part of these roles, he has assisted with the building of multi-billion-dollar infrastructure projects while also handling the installation of bridge structures such as the Peace River Bridge, the Patello Bridge, and the Massey Tunnel Replacement Project. So currently, Paul is responsible for sourcing, underwriting, and negotiating acquisitions across the Sunbelt states, as well as overseeing asset management for CPI Capital. So we believe this interview with Paul will bring great value to passive investors looking to learn about the step-by-step process of acquisitions and asset management, and to active investors looking to optimize their acquisition and asset management process. So welcome, Paul. Sorry, we do a lot of talking.
Welcome, Paul.
Yeah, thank you. I'm honored to be here. I'm super grateful for both of you guys, and just super excited. So
Amazing, amazing. So just very quickly here. So I used to build single family homes
Yes.
for a long time, for more than 10 years, and I know what it goes into project managing just a simple single family home.
Yeah, it's a lot of
You
work.
know, and when I connected with Paul a while ago, and he was talking about literally building bridges. I mean, these are, people trust their lives, driving over a bridge, and we just sometimes don't even realize how much work and the intricacies that goes into building bridges. But bringing that background and knowledge into our space, I was so excited to work with this guy and partner with this
Absolutely.
guy.
It's
So
so impressive. So, Paul, can you just start off by please telling us about your background and your start in real estate, please?
yeah, for sure. So I started off basically working with my parents at the age of 12 on their fix and flips. And at that time, I basically developed a passion for construction, and understanding also real estate and how real estate can increase your wealth. So I continued on the path of working as basically a laborer, carpenter, in the field of construction all the way through high school. Even as when I was working my summer job in college, I was always in construction. And one of the reasons I became a civil engineer is because I've always wanted to build something big. I've always had that passion to build these big, massive projects. And when I was graduating college, I wanted to actually go work for a developer. But for whatever reason, I didn't get the job at the time, and I tripped upon an opportunity to work with a contractor that built bridges. And so, during that time, I was working as an estimator, learning how to estimate properly these massive projects, and then taking what I learned from the estimate and applying it to the project that we would basically win, and taking that estimate into a budget and managing a team to basically complete the bridge. During that time when I was working for the bridge contractor, I was always still involved in real estate. So I would, every house that I would buy, I would basically live in it, fix it up, and sell it for a profit. And that was really tiring because I was working a full-time job, and then I would come home and I was basically flipping these houses all by myself. And then around 2015, I realized it's hard to do that. I got burnt out doing that so much, and especially I had a daughter that I was also taking care of. So, I realized that I needed to kind of leverage my time a little bit more. So, in around 2015, I actually quit my job uh, working for this commercial contractor and went headfirst into real estate. I had an opportunity to work with a private equity firm out of Denver, where we were basically acquiring multifamily assets. And so, learning basically everything that I've learned as a construction engineer and contractor, applying it to basically the multifamily acquisition and asset management side, and grew basically a good portfolio. And worked for that company for a couple of years, and then as time went on, I left that company for value reasons, and continued doing fix and flips and real estate development. And about 2 years ago, wanted to get back into multifamily and joined a mastermind group that was focused in multifamily, and realized that if I wanted to do it big, I needed a team to surround myself with. And that led me to basically meeting you guys and having conversations, and the rest is going to be history. So.
awesome. Really appreciate that background.
Yeah,
Yeah.
thanks for that, Paul. Now, let's dive into things. What skills from your engineering and project management background have you been able to bring to the real estate private equity side, and particularly in multifamily value add?
Yeah, absolutely. So, um, when I worked on many of these projects, sometimes I would actually work on the estimating team before we ever got the project. So, putting a whole business plan in place. Most of the projects that I worked on were public-private partnerships, meaning that you assemble a team with a banker, a design team, and a contracting team. So you're all coming together to basically uh, put an estimate together to build this massive project. Um, and so when we win the project, you would have this estimate that you would then have to turn basically into your budget and implement, the business plan that was already set out. Um, so and then while I was working in as a contractor, I'd be responsible for managing this budget, managing the schedule, looking at where we had pluses and minuses, and doing forecasting so that at the end of the day, we knew exactly where we were going to be profit wise, and making sure that we're completing these projects on schedule. So a lot of that translates into multifamily. So you find a deal, you underwrite it, you analyze it, you come up with basically a business plan. Once that business plan is established, and you're also working with property managers, contractors, lenders, so you're assembling a team to go after this one single project. So once that project is basically acquired, that's when you execute the business plan, just like you do in a bridge building project. Um, from there, you just make sure that you execute the business plan as you had set out in your estimate. And your estimate might not be perfect, but at least it's a guide to what you need to do in order to execute that plan. Um, and then just following that plan and making sure that you stay on budget. And if you're not on budget, then what do you need to do to make some adjustments? At the end of the day, close the project out and collect the check. So it's a very similar process.
Takes a lot of organization skills.
Mhm.
That's all I have to say
Definitely.
right
To
there.
say that Paul is organized is an understatement, but let's
That's
keep
right.
going.
All right, Paul,
Yeah.
I want to get right into things. So, as project managers, you usually have their projects on a like kind of like a moving Gantt chart.
Yep.
So, let's walk through the step-by-step process of acquisition and then asset management.
Yeah.
Okay. So yeah, so like even when you're putting an estimate together, you put basically your whole schedule together. So a timeline of what needs to happen.
And
And
it probably
some of the
starts, and I just wanted to jump in. It probably starts first with sourcing the deal.
Yep,
As an acquisition director, give us some of your top deal sourcing strategies, and then walk us through that.
got it. Okay, so some of the top deal sourcing strategies. So uh, it helps to have a network, really building a network of people between brokers, lenders, insurance companies, and mastermind groups. So you could also leverage people within the mastermind group that are in these specific markets that you have an interest in, that know their background, know their backyard, I should say, uh, much better than you would ever know, right? They're able to walk assets for you. They're able to kind of uh, kick the dirt better than you can virtually. So uh, you use your network, you leverage your network, you at least notify a bunch of people exactly what you're looking for. Be very specific in that criteria, and then deals start to come to you. So working with brokers, working with other members of mastermind groups and lenders and insurance companies, they have an idea of what you're looking for, and they start bringing deals to you as well. It also helps to have relationships with property management companies. So the property managers, they're usually the first ones to find out that their owner is wanting to sell. So it's helpful to establish relationships with these property management companies that they can bring deals to as well. So that helps building basically a giant funnel. All these properties are starting to come into this funnel, and then it's just a matter of kind of quickly evaluating which ones they can.
And we'll get into that in a quick moment. But talk to us differentiating between off-market deals and on-market deals. I'm writing an article about this over the next couple of weeks as well.
Yeah.
Talk to us about pros and cons. What's the difference between you always hear a lot of times sponsors have a deal and they're promoting the deal. There's an off-market deal. Off-market deal. What's so great about an off-market deal? And what are on-market deals rendered useless?
No, I wouldn't say that, but you always want to try to get your basically hand in the deal first. So when a seller is looking to sell a property, they usually engage a broker. And it costs a lot of money to obviously put together an underwriting package and an offering memorandum, and basically send it out to the market. And that takes a long time. So it's good to find basically a property off market, which is usually coming from a broker or a property manager or direct from the seller. Um, so to acquire those type of properties, you usually have to have a pretty good relationship with the broker or property manager or the seller themselves. So the reason they come to you is because they know you can execute and you can do it quickly. So once you see that a property is basically on market, it's kind of already gone through that process already. So that it's already kind of dragged along for that seller. Maybe the seller is a little bit more patient, and they want to see what the general market has to offer for this property. So if you could get it off market, get the property in your hands before it really goes out to the masses, you could probably get yourself a better deal. By the time it's on market, now you're competing with basically everybody else that's out there that has access to um, the internet, basically. So you're going to be probably paying a little bit more for that property, and unfortunately for the seller, it's going to take a little bit longer, but they might get a bigger price at the end. Whereas if you get it off market, you can probably get a better price as long as you can execute quickly.
Got it. Got it. And quickly here. So, what advice do you have to a newer firm? So, reputation is very important when it comes to deal flow. Brokers are not just going to send deals to tire kickers, as I was discussing on our call yesterday. So, how important is reputation? And if it's a newer firm or smaller firm that hasn't done a lot of deals in that particular market, how do you overcome that? How do you create optics to seem like a reputable, team that's going to close on deals to the broker, so they can't even take you seriously?
For sure. Yeah. Well, every expert was once a beginner, right? So you got to start somewhere, and it's just developing these relationships with the broker and developing a reputation of looking at the deals, underwriting the deals, and giving feedback. So it does take a little bit of time to nurture that, but as long as you're consistent, you get a deal from this broker, you underwrite it, you give them basically feedback of like, hey, this is where my number needs to be. And it might not jive exactly with what the seller wants, but at least you're letting the broker know that you're hungry, that you've got this desire for these properties, and that you're taking it seriously. You do that enough times and being consistent with that. That's when the broker might come to you and say, "Look, you've you've lost out on probably 4 or 5 deals. I've got this other seller that might have a deal that fits your criteria that you're looking for. Why don't you take a swing at it, and let's see what you can do with it before I put it out on the market." So it's just a matter of being consistent, and always being engaged with this broker or seller.
Right on. All right, Paul. So that's great. So now you have created deal flow, and the brokers are sending you deals on both on market and off market deals.
Yep.
So how do you keep all this organized? Is there some sort of a back of the napkin analysis you do to see if the deal even makes sense
Yeah,
first?
absolutely, absolutely. So the best way I've done it, and I'm sure there's other ways of doing it, but I have basically a property pipeline spreadsheet. So any deal that kind of passes the initial sniff test, I'll add it to this property pipeline spreadsheet that kind of lays out the different metrics. Um, what's the cap rate? What's the selling price or the whisper price? What's the NOI that's in place? Um, and then that's from that we're able to do a quick analysis, like we call it the back of the napkin analysis. It's just a 10-minute kind of overview, seeing where the market expense ratio is, and what your expenses are in place, and what they kind of need to be, so you can see what the potential rent growth is based on the NOI. And if you're based on the market cap rate, the NOI, and where you think the NOI can get to. And if you're within basically like 10 to 15% of the whisper price, then it's worth digging into a little bit more. So it has to pass that initial sniff test to see if you're within like the expected sell price that the seller is looking to do. And if you're way out to lunch, don't even bother. Just tell the broker, look, hey, my number's not going to even be close to what you're expecting. So all due respect, I'm going to bow out of this one to be the next one. So
That's
uh, yeah. So then once it passes that, then you could dive deeper into in the analysis.
And
Uh,
we'll get into that in a quick moment. Now we've been in an interesting type of interest rate environment. The Fed has increased the interest rates faster than they've ever done it, I believe, in history, raising interest rates 500 basis points in a matter of less than a year. Now, how does that factor in your underwriting? Do you source debt while you're underwriting deals? Do you have conversations with debt brokers already about to see what your rates are at? And then maybe you can touch on this metric of going in cap rate and your current interest rate you could get deals at. Maybe talk to us about quickly about debt as how it relates to your initial
yeah,
underwriting.
absolutely. And it's all about establishing your team ahead of time. So working with lenders that are seeing what the market is doing day to day, hour to hour, sort of thing. In my experience, there's some brokers or some lenders that I actually work with. As soon as I get a deal, I'll pass it over to them. Say, hey, what do you think that this property is worth? What do you think we can get for lending? Is it worth looking at bridge loans? Is it worth looking at permanent financing? Are there any other strategies that we could come up with that kind of fit a good model for this particular property? So it's engaging these brokers and lenders right off the bat. They're part of your team because they want to do these deals successfully too. So they have a vested interest. So I always reach out to them if there's a property that has passed the sniff test and the napkin underwriting. Then we get these guys involved, and then they can give us some guidance as to like here's where we think you might be in, say, like 30 days from now. So if you submit an offer, you need to kind of forecast what the market is doing. Nobody really knows. Nobody has that crystal ball, unfortunately. So you kind of have to project what is like if interest rates do climb up, what does my model look like? So you have to stress test it as well during that time. But it's just a matter of having these conversations with the lender, getting them to give you feedback on where the market is going, how the financing might look, your loan to value or your debt service credit ratio, what those minimums are going to be, and then yeah, you just build that basically into your model.
Got it. Got it.
all right. Okay. So the next step, let's talk about the next step now. So you have that deal that passed the initial sniff test. Walk us through detailed underwriting, please. Like first, what is the information you need to conduct detailed underwriting, and who provides this info to you?
Obviously, on a high level,
Yeah.
I know we've
There's a lot
we've
to
looked at
cover
deals
there.
together, and it's in all those different tabs and all those numbers. We could talk probably for the next week here about underwriting, but just walk us through. It passes the initial sniff test. You talked about getting involved the other stakeholders such as your debt brokers, but when you're putting those numbers in to your underwriting model, which is very sophisticated, what is the information you need? Who does that information come from? Talk to us on a very high level, the process of underwriting a deal, like full analysis that you do.
For sure. Yeah. So I think the most important things that you do need is, first of all, the current rent roll and the T12. Once you have that information, you can see what the history of this property is looking like. And then you're able to kind of forecast, okay, well, if your rents are currently at this, but your market is saying that it needs to be a little bit higher, then that's really the information you need. So first of all, you need the rent roll and the T12. That usually comes from the broker or directly from the seller. So the next thing that I typically look for is crime statistics. So I go on, do some research on the area. There's certain websites that I use to see what the crime looks like in the area, just to make sure that we're not in the war zone, or that we're not on the edge of where something might be happening or migrating, or the demographics are shifting. So it's always important to look at that. So the next thing I get is basically some guidance from my lender, as to what the loan to value or the debt service credit ratio might be, and where interest rates might be. Taking that information, and then that comes from the lender. And then talking to insurance. Insurance is I've learned in the past that insurance actually takes the longest to get the proper information. So you want to reach out to a lender, insurance broker right away to see, what are your typical insurance rates for that property in that market, and does that property or does that market have a history of natural events like hurricanes, flooding, things like that. They kind of look at it from another point of view, just to make sure that if it's in a danger zone, your insurance rates are going to go through the roof. So it's important to get that number two. So those are just typically the items that I first look for, and then the at least from third party sources. Uh, and then one last thing that is super crucial is to get some data from. Typically, we get it from CoStar. There are other programs that are out there, but CoStar does a really good job with showing the demographics of the market, the property specifics, some of the history with the property, the rent growth, vacancies, occupancies, and other rent comparables and sale comparables. So you basically collecting all that data just to kind of see what the trends are in that particular market and how you could apply that basically to this property. So those are the items that I would say are most important.
And just quickly now for some of our listener or viewers who can't visualize an underwriting model, you're inserting all of this information into this kind of Excel type of obviously it's a very sophisticated Excel model, and you're looking for to get some numbers out. So this is not only if the deal makes sense as far as the equity and the debt, but is also now you're dealing with investors' capital and what type of what is the profit share with those investors as well. So that's an important component of a underwriting model as well. So that kind of initially you got to see where is your equity coming from. If it's coming from LP investors, what is the profit share? What is the promote? What are the fees being charged? All those factors get added to the model as well?
Oh, absolutely. Yeah. So yeah, just like what you said. So you got to look at basically what you want to get to is your net operating income. Once you get your net operating income, then you can start structuring in your debt. Okay, now that you got your debt coverage taken care of, okay, now what's remaining out of the potential cash flow? So then from there, you're able to say, okay, well, I could carve out X amount of dollars to our limited partners or X amount of dollars to pref equity. And then basically after all that has been paid out, then you're left with basically the cash flow towards the general partnership. So uh, like I said, figure out the rent, figure out the expenses to calculate your NOI, then your debt coverage, making sure that's paid for, and then whatever's left out, you make sure that you carve out the right percentages to your team and partners.
Got it.
Right on, Paul. Can you talk to us about some of the red flags while underwriting? Like, for example, if the medium household income in the area is super, super low, would that?
Yeah, yep. You want to make sure that you check out the that average household income in that area, because you want to make sure that the tenants have the ability to afford the rent. So you do look at if the rent is say $1,000 a month, they need to be making three times that per month basically to afford that place. And your property manager should be screening these tenants to make sure that they have that affordability, right? So you do check the affordability of that area and that market. So if your household income is too low, that just means that your rents are going to be super low for that area too. So you want it pretty high and on average. I just had another thought of what to look out for. Crime is definitely an area that you want to keep an eye on. Insurance, we were looking at a deal recently in Houston that just happened to be in one of the worst locations in Houston for insurance costs. And my initial estimate on the insurance was three times less than what it should have been. That just shows like, wow, this is a red flag. So that's another thing that you need to look out for. Oh man, I had another great one for you that it might come to me later, but
Sure, sure. We'll just wait.
sorry, yeah, I came. You want to make sure that you got a good, diverse economy, not just a one-trick pony, right? So uh, certain economies, that we were looking at Colorado Springs, for example. Colorado Springs is known to have a good presence of military, but uh, in addition to just that military, if it was just the military, I would probably pass on that deal or in that market because you just never know what's going to happen with war or things happening with the government that now you got a mass exodus of people that might happen. So if if you got a military town, you want to make sure that it at least has supporting industries. So lots of private companies that are maybe they get government contracts or technology, healthcare, and education. So you want to make sure that it's a really well diverse economy as well.
Got it. Great.
Those are great red flags. Thanks for sharing that. Okay,
Yep.
Paul. So this is great. You sourced the deal. You've cherry
Yep.
picked the best deals. You underwrote the top deals. What's
Yep.
next? Like, talk to us on a high level about LOI and PSA and what's the difference? How
Yep.
long does the stage take? And who are the people that get involved in this?
Yeah, so by the time you get to the LOI stage, so the letter of intent. So the letter of intent is basically telling the broker and the seller, this is what I'm willing to offer on this property and my terms. Um, so it's not a contract obligation at this time, but it's letting them know this is what we intend to do. So if the property is on market, there's a call for offer date. That call for offer date is the date that you normally submit your offer on. And then sometimes there's another round known as best and final. So, they have probably 15, 20 different groups that have submitted an offer. They select the best five groups, and then they say, okay, you've made it to the top five. Please give us your best offer. And so you get another chance to kind of sharpen your pencil a little bit more, seeing what you could actually get. Or, like what I always do is pretty much just say, well, my number was my number, um, and, uh, and I can't sharpen that pencil anymore. So I'd rather not go over too much on my offer price. So so say you do win the deal, your offer was accepted, your letter of intent was accepted, then you basically have say like 10 to 30 days to put together a purchase and sale agreement. That's so before the LOI is submitted, you want to make sure that you have at least your lender on board, a property manager kind of that you've been talking to, and an insurance guy on board as far as your as third party groups. Um, Once you get into an offer that's accepted and you have your purchase and sale agreement, that's when you get your attorney involved. You need to have an attorney that's going to either write up this purchase and sale agreement or review it for you, and making sure that you're um, covering basically protecting yourself from any other issues. You're also identifying the terms or the length of time that you need for due diligence, that you need for lending approvals, anything else that might be coming up during this time. So that takes typically 10 to 30 days to negotiate that and put that basically sign that agreement. And once you have that agreement now signed, you have typically 30 to 45 days, depending on what you need for due diligence. So then that's when you're going to the property, you're inspecting all the units, you're walking through each unit with a contractor, the property manager. You're bringing other contractors to the property to inspect the roofs, to inspect sewers, and really getting a really deep dive into the overall health of the building and the structure. You bring in the property manager, they're looking at the leases, the lease audits, and we've got a full-on 300 item document for due diligence. Of all the things that we need to check for and go through and make sure that we looked at it. So that takes 30 to 45 days. So once your 30 to 45 day due diligence period is ended, Then you have another 30 days basically to close. So this time your lender is still working with you, your insurance guy is still working with you, your property manager is also working with you, and basically putting all these puzzle pieces in place just to make sure that your underwriting is still good and still valid, that your lender is working towards qualifying the sponsor for the loan, and presenting the deal to their different banks or Freddie Mac or Fannie Mae, getting their approvals. So that's basically another 30 days after your due diligence, and then that's when you typically close. But you want to also put an opportunity to extend the contract if you really needed to. If something came up, your lender needs a little bit more time. We need a little bit more time to raise capital, something like that. So at least you have an option to extend another 30 days. So
You talk about quickly, just for me to interject, you talk about raising capital. All these items that Paul is talking about, this is a parallel line that is also with raising capital. So Paul is conducting all of those steps on his side, on the acquisition side. Ava and I are running the investor relations, creating the marketing material, sending that to investors, getting everybody ready, talking to legal, getting those securities documents ready for the next step. So it's really
subscription agreement and limited partnership agreement, and
it's really a team effort here to us working together. But keep going. I think Ava wanted to quickly say something as well.
Well, just in reality, for new syndicators or even for investors, Paul, in reality, how many deals do you have to underwrite, submit offers on to then actually get a deal?
100 to 1. You're underwriting a lot. We're looking at a lot of properties, basically like you got to use your time wisely, right? So, yeah, you're looking at a lot of deals are just not going to pencil out. And the more you do this, the more you kind of see, yeah, this is a good deal, or this has potential, or no, like this seller is way out to lunch. So it's looking at a lot of deals before you get down to basically that one that makes sense. And then you're also competing with other guys in the market too, especially if it's on market. You got to compete with them and go through that length of time. So during that time, when you're in that LOI stage, you're really now focused on that one deal. You don't want to be doing too many other deals at that time, because that's your priority. Just getting that one done. And there's a lot of work to happen in between as soon as the LOI is accepted and you actually close. Just like you said, we're all working in parallel to make this happen.
It's a lot of work, but let's just say, okay, great, the deal's closed, everybody's happy, but in reality, the hard work is really just beginning, right?
Absolutely. Yep.
So you need to create the business plan. I'm guessing there is a business plan built ahead of time, but tell us most commonly, what are the first steps taken? Like, what are the first steps taken when a multifamily value add property is acquired?
And just for our viewers and listeners who might not be familiar with value add, basically value add is where you purchase an already existing multifamily asset, is already stabilized, and your business plan is to go in there and increase the value by doing some small renovations, by increasing the occupancy. So that's essentially what multifamily value add describes. But yeah, when you finally close on a multifamily value add deal, what's the first thing you do? Because there's a lot of stuff to be done. What's the first thing that takes place? Walk us through that process of taking over the property.
For sure. Well, before you actually close, you want to make sure that you have your business plan all done and sat down with your property manager, because your property manager and contractor are the two major things that can really change the outcome of the deal. So you want to make sure that they're on board with your business plan before you even close. So everybody is aware of what the business plan is. They're on board with it, and they're ready to execute. So the day that you close, you want that property manager already there, making the changes that you're looking to do. So day one, you got your property manager on site, basically making introductions to all the tenants, letting them know that there's a change of ownership, and that we're there to improve the quality of their life. Basically, we're there to help them feel safe and secure in this new ownership. That there will be some changes. There's going to be some renovations and things coming up. But that's basically day one. You get in the ground, you start making those changes. Your contractor is the other important team that you want to have on board even before you close. And when you have basically the timeline already set aside, when you're okay, so we're going to close in the next 30 days, and you start negotiating basically with your contractor to get them prepared to hit the ground running almost day one. So you want to give yourself a little bit of buffer at least, just to make sure that the property manager has a good handle on the asset, that their business plan is getting ready to execute, and then within 30 days, you want to make sure that your contractor is there on site with materials already pre-ordered, and basically when there's vacancies, you jump on those vacancy or those vacant units right away to start renovation. So that's the ideal situation. Sometimes it doesn't always work out that way, but you want all these people lined up, ready to execute their business plan, basically the day of close. So.
Got it. So notify the tenants, have all your contractor ready, property manager ready, start turning units right away, start renovation process as soon as you take over the property. This is basically exterior and interior upgrades right away. A quick question for you. Over the last 12 years, I mean, not the last year, but 12 years prior to that, we've been on a hyper type of market where prices have gone up, rents have gone up. It's just been the gravy train, if you want to call it, really. And some sponsors would purchase properties and they wouldn't even do any value add because the rents were increasing so much, the loss to lease was so great that they didn't even need to do the value add. What is your prediction currently with what's happening with the market? Obviously, we know some areas the rents are dropping, some areas rents are flat. How important is value add, and is value add still a feasible process if rents are not increasing? Is that all depends on loss to lease? Give us a quick thesis on this.
Yeah, that's a really good question. So my thought is that you always want to improve the property, and you want to make it attractive for people to move into the property. There's lots of development that's actually happening in different markets right now. So there's going to be availability of brand new properties on the market, and that they're trying to
a million units coming to the market nationwide over here. But keep going.
Yeah, so that they're going to absorb a lot of tenants, and they're going to absorb a lot of the market, and you are going to probably see some vacancies amongst all the other multifamily assets. So if you aren't proactive at adding value to the property and making it look attractive to your tenants, they're going to move out. They're going to look for another place that's better, and then you're dealing with a problem of high vacancy, and then your NOI is going to drop. So you want to do your best to basically retain those tenants. So you always build it into the business plan that you're going to be renovating the exterior and the interior, and it's always best to, I think, execute on that. If throughout the life of, say, the project that you own, if you see that things aren't happening that way, that you could probably trim down on some of the cost of construction and things like that, and if you're able to increase your rents without doing Class A type of renovations, stay with that. Adapt and change to what the market is telling you. But I think you always want to be prepared to make those renovations happen, because you've got a lot of competition that's brand new on the market that's a lot more sexier than a property that's built in 1980s. So, okay. And probably a lot more amenities too. So.
Got a couple more questions before we get to the next segment of our show. Thank you so much for giving us so much knowledge. Let's talk about this rent increase, right? Obviously, we're both based in Canada. Our investments are only in the U.S. We only invest in the U.S. because, in a certain states within the U.S. where landlord-friendly laws, is reality has checked in. If you don't pay your rent, you get kicked out, and there's no real rent control laws in place. You basically, free market capitalism wins. If you don't take care of your tenants, if your rents are not reasonable numbers, you just lose them to another property. So again, it's free market capitalism. But aside from the kind of concept of rent control, when you talk about increasing rent, let's just walk through the process. We buy a 100-unit apartment building. It's 90% occupied. You have 10 units that are vacant. We go in there, we renovate those units right very close to where we have taken possession. We do some outside renovations as well. The asset is better now. The question is this: what happens with those 10 units? Is the process to offer them to the existing tenants for a premium? If the rents are $1,000, you offer those at $1,200. Do you market it? Is it something you work with a property manager? Talk to us about the kind of the basically the foundation of value add, if you may.
Yeah, absolutely. I think a lot of it probably has to do with the tenants that are already there in that property. And if you are doing a heavy value add, a lot of those tenants might be comfortable in the condition of the property that you have, and maybe you don't want some of those tenants, right? So they might, the previous property manager may have not screened the tenants properly to verify income, other sex offenders or other red flags of things that you want to keep away from your property, right? So even though you have these 10 vacant units available that you could renovate, it depends on like the current demographics of your tenant base, just to make sure, do you really want them to stay? So that's something that you really got to consider, and you'll find that out during your due diligence when you do lease audits and you're walking through each one of these units, and then you might identify which ones are, you know, bad tenants. So you want to kind of try to force them out if you can. Um, but one of the things that I think is important is your exterior needs to um, look like the curb appeal. You need to focus on that first, really, before you really dive too deep into renovating all these units, because you want to show the rest of the tenant base that you're adding value overall. You want the place to look good. You want them to feel good about living there. So if you can justify to them, hey, we've already done all the roofs, we've painted all the exterior, we, filled up the pool that has been sitting empty for the last couple of years, we're making these changes. Um, and when they see those changes, they see that the value is there, that you guys are improving this property. And that is a way for us to justify probably a potential uh, increase in the rents without renovating too much as well. When their lease comes up, bringing their lease up to market. So you could do it two ways. So you could renovate the units, move them over, or bring in new tenants, new qualified tenants, and increase the exterior value, curb appeal, and then you're able to increase the rents of the existing tenants as well, just based on that. So
Last question.
yeah,
When it comes to the brand, so a lot of times I talk to investors and partners and even some of my friends. I talk about that we are in real estate, we buy real estate assets, but essentially we're buying a business. Multifamily, institutional multifamily assets behave just like a business because we buy them on those bases of the income it produces. It's really, managed just like a business. And a business has a brand. Every time one of these apartment communities, we were in Florida and Naples, and we drove by a couple of these nice apartment communities that look really nice from the outside. They have a brand, and I Googled it. They have Google reviews. How important is the brand associated with an asset? And then how important is it optimizing and making that brand better when we take over? Is that something completely in the hands of the property management firm we handle? Do we get involved in that whole process of the branding?
yeah,
Talk.
yeah, definitely. Branding is key, right? So you want to develop a reputation, and like if tenants find out like who the owner is or the property management company is, they're gonna do the reviews, right? They want to see how this property manager treats their tenants, or how the owners treat their tenants. So you want to make sure that you do get the branding taken care of. So you could even work with, say, like a marketing or branding expert to come up with attractive names, like something that is unique to maybe the area, or unique to basically like uh, what we're building here. And keeping things consistent, coming up with that name, rebranding the whole property. Sometimes the property itself has a bad name and has a bad reputation. And so you want to kind of cut that away. You want to get rid of that. and bring in a brand new name, maybe change the color scheme, or at least keep a color scheme of properties that are consistent. And then once you have that, tenants realize, oh, well, they have this property, they could identify that it's all owned by the same company and managed by probably the same property manager in that area. And so they know that you're going to be have a good product. They're going to treat your tenants right. You're going to attract more that way. So it is important to have your branding in place.
Awesome. Thanks so much, man. Really appreciate it.
Paul's a wealth of knowledge. See
Yeah.
why we,
And to people who've stayed tuned this far and you're listening to this or you watching this, we are starting a a regularly set webinar that's going to be hosted by Paul, where he's going to be talking about these things in much more detail. He's going to bring on other experts as well. So watch out for that in our email. Subscribe to our newsletter, and you'll be updated on when those webinars will start. It should be probably starting over the next few weeks or the next month, and they're going to be great.
I'm really excited for those.
Really excited. So let's get to the next segment of our show.
Okay, here we go, Paul. It's the 10 championship rounds to financial freedom. Whatever comes to mind, I'm going to ask you 10 questions.
Okay.
Let's do it. First question. Who has been the most influential person in your life?
Oh boy. Well, I would I would say collectively my family. They've always pushed me to go beyond, above average, right? So always instilling the proper values into my life, teaching me about discipline, and hard work. So I would say, collectively it's my family.
And that's your immediate family, parents,
my parents, my brother, and currently my wife, and even looking at my daughter too, and just making sure that I'm a proper role model for her. So
amazing.
Beautiful.
Definitely are.
All right, Paul, next question. What is the #1 book you'd recommend?
And it doesn't have to be a real estate investing book. Right. Any book, for whatever reason, maybe a book that comes. Yeah, we can see a lot of books there.
Yeah. Becoming Supernatural.
Oh, wow.
By Dr. Joe Dispenza.
Oh, I love Dr. Joe Dispenza. Okay. Again, we share a lot of the same interests.
You can see that this book is beaten up. But I've read this book several times. I've listened to the audiobook several times.
Nice.
That book has changed, basically gave me a complete paradigm shift of reality, my life, just everything. So I highly recommend that book to anybody.
Amazing.
Right on. Okay, Paul, if you had the opportunity to travel back in time, what advice would you give your younger self?
Start earlier and be patient.
Yeah. Nice. Okay, next question. What's the best investment you've ever made?
In myself.
Right on.
Absolutely.
Okay. Yeah. Perfect. What's the worst investment you ever made, and what lessons did you learn from it?
Worst investment. When I first started kind of understanding commercial investing and syndication, I invested as an LP with a group that I wish I didn't. It had all the red flags. Looking back now, I don't know what I was thinking. So, but I trusted this person. They were, a guru. They've kind of they had their own education platform and things like that. They're not around anymore, so I'm not going to say who the name was, but I invested with them, and everything about it was wrong. The paperwork, the business plan, how it's executed, all just wrong. And learned a lot of good lessons out of that. So basically, do your due diligence on the person, on the business plan, hiring a lawyer to look at the paperwork and making sure that you know what you're looking at, because you don't know what you don't know. I was just getting into it, and it looked attractive, and I trusted this person, but in the end, it was a complete failure.
It can be overwhelming, right? It's a 200-page document that you're signing off on, and there's so many different things to.
Sure, yeah.
Absolutely. Was it a total loss, Paul?
Yep.
Oh, wow. Okay.
Sorry to hear.
Yeah.
You live and you learn, and you.
Yeah, it was a good education. Let's just say
Sure.
I invested in a good education.
There you go.
Absolutely.
All right, Paul, next question. How much would you need in the bank to retire today? What's your number?
Well, money in the bank isn't really the most important thing. It's cash flow.
Nice.
So
Nice.
yeah, so I guess it really doesn't matter how much I have in the bank as long as I have enough cash flow. But the net worth and cash flow that I need, I've always had the number of a net worth of 10 million. So whether you want to say that's in the bank or in assets, that's really what I'm looking for.
Amazing.
Awesome.
Okay, Paul, if you could have dinner with someone dead or alive, who would it be?
Good question. Dead, I would have to probably say Marcus Aurelius. I study Stoicism. He's probably one of the great of the Stoics, and it would just be great to be around in his presence. And yeah, I think Marcus Aurelius for somebody that's dead. Somebody alive, Tom Bilyeu of Impact Theory.
Oh, yes. Right on. Okay.
You know what? Sorry. Yeah.
Well, maybe you'll get on the show one day yourself. You never
That'd be
know.
awesome.
Wouldn't
Yeah.
that? Oh, that's a good one. Okay, perfect. Okay, next question, Paul. If you weren't doing what you're doing today, what would you be doing now?
Probably traveling the world snowboarding would be one. Traveling and snowboarding the world. So
We're still gonna be doing that, man. We're still gonna be doing
August will
that.
be right beside you.
Yeah, we've done already.
Skis.
We already snowboarded and skied together in Whistler. So he's very good. He's a very good snowboarder. So
Yeah, that was
all
a
right,
lot
let's
of
keep
fun.
going.
Okay, my favorite question: book smarts or street smarts?
street smarts.
Okay.
Yeah.
Okay, we love that. And the last question, Paul. If you had $1 million in cash and you had to make one investment today, what would it be?
Today, I would do probably invest into a mastermind group and surround myself with people that can make that money grow tenfold.
It's all about who you surround yourself with.
I gotta be honest. One of the best answers to most of these questions. So
That's why we
you would
partnered
think
with
that he
him.
had a cheat sheet. You would think that he was so good. No,
Amazing,
it
Paul.
was excellent.
I
Thank
couldn't
you
wait
so
for
much,
that.
man. No, we really appreciate it again. And maybe you can quickly tell people how they can reach out to you if there's brokers out there with a lot of deals or there's off-market deals, how they can reach out to you.
Yeah, you could reach out to me by my email now. It's paul@cpicapital.ca.
Right
Perfect.
on.
Awesome.
Right on.
All right, everyone.
And if anybody wants to connect with Paul on LinkedIn, it's just Paul Hopkins, or you could check him out on our website, which is just www.cpicapital.ca. This has been amazing, Paul. We're so happy to have you on board. And
Yeah, so grateful.
Thank
Yeah,
you.
thank you.
Thank you for joining us for this episode. We hope this conversation enlightened you on how to win big in this highly profitable and risk-averse space. Get on your feet and embrace this world that offers so many opportunities just waiting for you out there. Continue your journey to becoming a savvy real estate expert by subscribing to the show at cpicapital.ca. Don't forget to leave a positive rating and share with your friends. See you on the next one.